what we're seeing is proof that the Fed has already lost. Inflation won. The Fed can't possibly raise rates high enough to reduce inflation without crippling the economy, without creating a worse financial crisis than 2008.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
So the big story of the week, I think, is the market itself. The continuous decline in the major stock market averages. It was actually the third consecutive losing week for the S&P and the Dow. That's the biggest losing streak since February. The Nasdaq, though, was also down for 3 consecutive weeks. That hasn't happened at all this year. The last time that happened was in December of last year. The banks also get beat up on the week, 3 weeks in a row now for the regional banks going down. And it was 4 weeks ago that I did my podcast, where the title of my podcast was, Did the AI-Fueled NASDAQ Bubble Just Pop? So I almost nailed the very top of the market. Now, of course, I did end it with a question mark, so I can't really claim credit like, yeah, I emphatically called the top, because then I would have ended it with a period or an explanation point. So I kind of covered my butt a little bit by putting a question mark at the end. But at least I was right to question whether we had seen a top, because what I saw looked suspicious to me that maybe there was a top, because I've been expecting one for the reason of rising bond yields. I mean, that was what I thought was the most significant fact that stock investors were overlooking, was the carnage that I saw in the bond market and that I thought would continue. And I nailed that perfectly, because bonds were down now for the 5th consecutive week. So the 5th week in a row where bond yields have risen. And that's why now for 3 of those 5 weeks, the stock market has followed the bond market lower, which is what I thought was likely to happen. Now, I'm still very bearish on bonds. I don't think we're close to the bottom of this bear market. Remember, I talked on that podcast even 4 weeks ago when I was warning about the potential sell-off in the stock market, that there were a lot of bond bulls that I thought were going to get, taken out and shot. I talked about Jeff Gundlach and a lot of other big bond guys that were saying, buy the 10-year, we're going to get a rally. There were a lot of speculators trying to pick the bottom of that market. And I said, they're going to get burned. They're on the wrong side of this trade. This bond bear has got a long way to go. I mean, this is a secular. It's not cyclical. This, I believe, is a secular bear market that's going to be here for decades. Just like the secular bull market was here for decades. We had a bull market in bonds from 1981 to 2021, like a 40-year bull market. It's over. And it ended with a bang, during COVID, with, yields going down below 1%, right, for those maturities. And that was it. And I actually called that top in real time. I didn't even put a question mark there. I said, this is it. The bond bull is over. This is the blowout top of that, 40-year bull market. And I was right on that. But the yields are continuing to rise. And so I think they're going to keep rising. And so that means that the pressure on the stock market is going to continue. In fact, the decline so far, I jotted them down. So the Dow is only down 3.3% from the peak. So that index has held up. Of course, it didn't go up quite as much. The S&P is down 5.2% now during those 3 weeks. The Russell 2000 is down 7.4%, much more substantial, right? I think we need 10% to be in correction territory, so we're not quite there. And the NASDAQ is down 7.7%. Now, if you look at the more speculative stocks, Or that's not the NASDAQ. That's the NASDAQ 100. I didn't write down the overall NASDAQ. Look at the Cathie Wood ARK Innovation ETF. It's down 21.3%. It's already gone through correction territory into bear market territory. Now, of course, I mean, this is a very volatile fund, so maybe it's not as significant as the entire market, but it still gives you an indication on what's happening. By the way, you Bitcoin bugs, the Grayscale Bitcoin Trust is now down 20.5% from its peak, so that's bear market territory. Bitcoin itself is not down quite as much. I think it's down about 17.5%. The high it got to was around 31,500-ish approximately. And as I'm recording this podcast Sunday night, we're barely holding on to a 26 handle. We're around 26,100. We have traded 25,000 and change. So I think there's a lot of room to fall. But this is what's going on with risk assets. They are going down right now, led lower, I think, by crypto-related assets, but all the risk assets are going down. But everything has been going down. Look, gold's down too. Gold's down from its highs about 8% from the high that it touched in the last year. We're right now just below 1,900. I mean, 1,890-ish or something like that. But gold is still holding up pretty well recently. It hasn't gone down that much recently. Gold stocks, again, from their 52-week highs are down in bear market territory. They're down about 24% if you look at the GDX, GDXJ. But I think that you're going to see a break from gold and bonds. Now, part of that is the dollar. I said that bond yields rose for 5 weeks in a row. Well, the dollar rose for 5 weeks in a row as well. The dollar is going up with bond yields. But that's not what should be happening. And eventually, this is going to decouple. I think that you're going to see the dollar and bonds falling together, because the real reason that bonds are weak is because inflation is strong and going to get stronger. See, right now, people still look at the inflation data and the fact that it's stubbornly high, and the Fed is now concerned that it might rear its head, as if its head ever disappeared. But, they were talking about inflation coming down. It went down from 9 to 3, but now it looks like it's going back up. And so the markets are looking at the resurgence in inflation, and their conclusion is, okay, the Fed's just going to have to fight a little harder to win this battle. It's going to have to raise rates a little more and keep them higher for longer. And that mentality has been propping up the dollar and suppressing gold. Now, the dollar hasn't made a new high. Gold hasn't made a new low, but it has keeping a bid in the dollar, and it's keeping pressure on gold. But eventually, as I've been saying, investors are going to have to realize that inflation sticking around longer than people thought. The fact that they can't slay this beast, this is not an indication that the Fed just has to fight harder to win. No, what we're seeing is proof that the Fed has already lost. Inflation won. The Fed can't possibly raise rates high enough to reduce inflation without crippling the economy, without creating a worse financial crisis than 2008. This fantasy, though, is still out there in the market. But at some point, the investors are going to be confronted with reality. And that reality is those days of really low inflation, they're gone. We're not going back to 2%, not even close. We're going to be much higher. And that's why you're going to see a much bigger backup in bond yields. For example, if you look at the yields right now, and I got them up here, the 3-month Treasury bill is yielded 5.4%. But the 10-year is 4.3. The 10-year is over 100 basis points lower than the 90-day. That's not normal. Historically, if you've got 5.4% Treasury bills, a 10-year is going to be 6, maybe more. And a 30-year, maybe 7. Normally, you have a positively sloping yield curve because of the added risk. There's a lot more risk when you loan the government money for 10 years or 30 years than for 90 days. I mean, how much can go wrong in 90 days? I mean, eventually a lot will go wrong in 90 days, but clearly there's a lot more time for stuff to go wrong in 10 years and certainly in 30 years. So all of that potential for something bad to happen, you needs to be priced in. You need to get paid more to take 30 years of risk versus 90 days of risk, or even, so what's happening now is atypical. So why is it that the 10-year or longer maturities are so low? Because everybody is under the false belief that these high rates, this 5% plus rate, is just temporary, that we're going to go right back to 1 or 2 or something like that, or maybe 0, who knows? And so people are willing to buy the 10-year or the 30-year at such a discount to what they could get, because why do that? If you could get 5.4 on a 90-day bill, what the hell are you doing fooling around with a 10-year treasury that yields less? Why are you taking all this risk and getting paid less? Because they are speculating. The people buying the long end of the yield curve, right, like a Jeff Gundlach, these guys are speculating. They're betting that the Fed is going to cut rates in the short end, and so your ability to get 5% in a 90-day is going to go away. That those rates are going to go down to 4 or 3 or 2, and now they're going to look like geniuses because they're going to be clipping coupons at 4.3, and everybody else is going to be stuck with these low rates. Well, what if it doesn't go down that way? What if the Fed can't lower interest rates, even if it wants to, because inflation doesn't go down? And in fact, it may start cutting rates and have to abort it because inflation takes off, because the minute they start cutting rates, the dollar falls through the floor, because I think it's getting ready to do that. I don't think there's any real support anymore other than the talk about higher rates and the belief that the inflation genie is going back in that bottle. But when the reality sets in that that's not going to happen, that we're going to have historically high levels of inflation, the yield curve is going to normalize. In fact, it's going to be steeper than normal because inflation is going to be accelerating even faster than normal. So when we go back to those days, then if you have a 5.4% yield on a 90-day bill, then you're going to have 6%, 7% or more. And we may not stop in the 5s. The Fed may have to keep hiking short-term rates. There's a lot of risk for rates going much higher than people think. Yes, the economy is going to collapse or fall into recession. That's what all the bond bulls are betting on. They're betting that when the higher rates finally take their toll and create a recession, that the Fed is going to do what it's always done and cut rates. But what if inflation is not low? In fact, what if inflation is higher by the time we officially enter recession? In fact, what if it's higher inflation that is the catalyst to cause that recession? The Fed can't go and cut rates if inflation is the problem, because cutting rates will make that problem worse, which will actually sedate the economy that the Fed is trying to stimulate. In other words, it's checkmate for the Fed, right? The game is over. It can't do this anymore. The only way it got away with this stimulus in the past was because it was able to pretend that we didn't have enough inflation and that it needed to get the rate up to 2%, its made up target, right? Well, if it's already way above 2%, they can't play that game anymore, right? They can't, get away with that BS because no one's going to buy it. And so the bond market is going to get killed, and that's going to be a big problem for the stock market, because one of the reasons that the stock market gets saved, right, whenever the stock market goes down because of problems in the economy, problems for earnings, well, the Fed rescues the stock market by cutting interest rates, which now pushes up stock valuations and, of course, drives more people into the stock market because they can't get any yield in the bond market. Well, that's going to blow up too. So the markets are completely ignoring what is likely to happen.